Drenad Trustier, a quantitative analyst, or quant for short, has exposed how you can outperform on investments. In this video, I'm going to break down key quant secrets to outperform in 2025, how quants avoid paying taxes legally, secret ways quants pay low mortgage interest rates, and secret ways quants report to the IRS. Now let's begin with the leverage AI powered quant funds. That's what they do. So quant funds driven by AI algorithms have shown strong performance, with some posting gains above 20% recently. So these funds use historical data and macroeconomic trends to inform trades, reducing human bias and improving decision-making accuracy. That's what the quants use. They use data-driven models and algorithms, so successful quant investing relies on building and deploying mathematical models that analyze large data sets to identify patterns and opportunities. Strategies include statistical arbitrage, factor investing, risk parity, and machine learning techniques. There's ultimate trading execution, so automation ensures timely execution of trades based on model signals, minimizing emotional interference and capturing market opportunities efficiently. They focus on risk management and diversification. So even quant strategies emphasize managing risk through diversification across asset classes and basically strategies to optimize risk-adjusted returns, not just absolute returns. They adopt cutting-edge technologies and tools, utilizing advanced AI models, prompt engineering, and platforms that allow rule-based automated trading. Even for retail investors, can enhance quant strategy effectiveness. In the comment section, let me know the platform you feel will be best suited to achieve that. There's the continuous model testing and adaptation. So back testing models on historical data and updating them with new information is crucial to maintain an edge in changing market conditions. So now let's look at why quant strategies are gaining momentum in 2025. So quant funds now represent a significant portion of hedge fund market and US stock market capitalization, highlighting their growing influence, right? AI enhances the ability to process big data and generate actionable investment insights, making quant investing more accessible and effective. Now, there's market volatility and macroeconomic shifts that favor systematic, data-driven approaches that can adapt quickly and objectively compared to discretionary investing. There's common legal tax avoidance strategies, right? Now let's get into that. They maximize deductions and credits. They claim all available deductions, business expenses, home office education, charitable donations, and tax credits like energy efficiency and education as examples to reduce taxable income. They use tax advantage accounts, so using retirement accounts like IRAs or Roth IRAs and 401ks to defer or avoid taxes on investment gains. Roth accounts, for example, allow for tax-free growth and withdrawals under certain conditions. They use long-term capital gains, like holding investments for over a year, to qualify for lower long-term capital gains tax rates, which are often more favorable than short-term rates. There's tax loss harvesting, selling, losing investments to offset gains from winners, reducing net taxable, capital gains. The buy, borrow, die strategy is what they use too. Wealthy investors may, buy appreciating assets, borrowing against them, right? Loans are not taxable income, just for you and then pass the assets to heirs. Upon death, heirs receive a step up in cost, basis, minimizing capital gains taxes. They have like an offshoring and international tax planning approach too, establishing residency or entities in low tax jurisdictions or countries with favorable tax treaties. This can include moving to countries with no capital gains tax or using offshore accounts and subsidiaries, provided all reporting requirements are met. They're using, they use standard or itemized deductions. So choosing between, the standard deduction and itemizing depending on which yields the greatest tax benefit. There's seller paid rate buy downs, like seller concessions. So sellers or builders can contribute funds, to buy down the buyer's mortgage interest rate, effectively lowering monthly payments without reducing the purchase price. So this is a common in basically high rate markets to incentivize buyers. They buy discount points, so borrowers pay upfront fees like points to the lender to reduce the interest rate for the life of the loan. Each point typically lowers the rate by about 0.25%. This is a long-term saving strategy if you plan to stay in the home for many years. There's rate buy downs, which is temporary. So temporary buy downs like 2-1 or 3-1 buy downs reduce the rate for the first few years, providing lower initial payments. This is useful if income is expected to increase or if refinancing is planned later. There's assumable mortgages, so some government-backed loans like FHA, VA, USDA are assumable, meaning a buyer can take over the seller's existing low-rate mortgage. This can bypass current higher rates, though buyers must cover the seller's equity. They're shopping around and negotiating, so getting multiple loan offers from different lenders basically creates competition, so often resulting in better rates or waived fees. So quants leverage this to negotiate aggressively. There's portfolio loans from small banks. So smaller banks that keep loans on their books may offer more flexible and lower rates to strong borrowers as oppressed or as opposed to big banks selling loans on the secondary market. There's employer mortgage assistance programs. So some employers offer mortgage assistance benefits that can reduce interest rates or cover upfront costs, which is a lesser known perk worth exploring. There's community development financial institutions, also known as CDFIs. These mission-driven lenders offer lower rates in underserved communities, which can be a hidden source of cheaper financing. Okay. Then there's the making extra or bi-weekly payments. So while not directly lowering the rate, making payments more frequently or extra payments reduces principal faster, basically cutting total interest paid over the loan term. There's the using of credit score and loan terms as leverage. So maintaining excellent credit scores, increasing down payments, or choosing shorter loan terms can help secure lower rates. Now, here are some key reporting mechanisms that quants use when it comes to the IRS. So there's information returns. So most income is reported to the IRS through information returns like W-2s, basically wages, 1099s, which is interest, dividends, securities transactions, and scheduled K-1s, which is partnership and trust income. So the IRS uses advanced computer systems to match these third-party reports with individual tax returns. Now, the pass-through entities, many quants, especially those involved in hedge funds or private equity, receive income through partnerships or LLCs. So these entities file K-1 forms, passing income deductions and credits to individual partners or members who then report them on their personal returns, right? Then they have the secretive and opaque practices. So layering and shell companies, the ultra wealthy often use intricate webs of partnerships, shell companies, and trusts. So K-1 forms may list anonymous entities or omit key details, making it difficult for the IRS to identify the ultimate beneficial owner. Sometimes K-1s only provide a string of numbers or a bank account, not a name, further obscuring the trail, okay? Then they exploit the IRS weaknesses. So due to years of budget cuts and a shortage of experienced agents, the IRS often struggles to enforce tax compliance among the ultra wealthy. So accountants and lawyers exploit these weaknesses using legal but opaque structures to shield clients from scrutiny. There's minimal enforcement. So the IRS's Large Business and International, LB&I division, which handles audits of corporations and the ultra wealthy, often avoids aggressive enforcements. Agents rarely issue legally binding summonses and may give taxpayers multiple chances to comply voluntarily. Even when potential fraud is detected, the IRS may not pursue criminal referrals, instead settling on back taxes owed. So there's IRS detection and audit triggers. So discriminant analysts, right? So the IRS uses statistical models like the DIF score to flag returns for audit. High ratios of deductions to income, especially on schedules A, C, and F, can trigger audits. However, complex partnership structures can make it harder for these models to detect underreporting among quants and the ultra wealthy. Okay, then there's matching and data analysis. So the IRS matches reported income from various sources. There's discrepancies between what is reported by third parties like banks, partnerships, employers, etc., and what is claimed on personal returns are basically a major trigger for audits. So that is what I have for you today. Please take a moment right now to hit that subscribe button and like button. If you appreciate this video and you gain value from it and you want more videos like this, let me know that by hitting that subscribe button and the like button right now. Also, let me know your opinions in the comment section below. I appreciate your viewership. Stay safe and see you on the next video.